Well, we're bond investors, so Ellie, thank you very much for bringing up the optimism, but I'm afraid I'm a bond investor, so I'm going to have to bring us back to the themes we were on. I want to thank the Thai Bond Market Association for including PIMCO in this afternoon's event, and I'm very honored to sit on a panel with these distinguished gentlemen and speak to you today. The title of my presentation are Extraordinary and Experimental Monetary Policies, Benefits, Costs, and Risks. And that is how Ben Bernanke described quantitative easing in August of 2010 and has since described it like that in several other instances, that these programs have benefits, costs, and risks. As we know that there is a lot more debate today within the Fed on whether the benefits outweigh the costs and risks, or are the costs and risks outweighing the benefits, and that debate will continue. But it is not only the Fed that is doing quantitative easing, it's also the BOE, the ECB, and now the Bank of Japan. So I'd like to lay out the objectives of these extraordinary policies and their effectiveness on the economic growth of their countries, and more importantly, the costs and risks that they're putting in the financial markets. Well, there are three objectives of the Fed. It's to flatten the forward yield curve, real yield curve, reduce interest rate volatility, and therefore the term premium on bonds, and then push investors out the risk spectrum. And the Fed is trying to support economic growth. They're trying to offset fiscal headwinds that they're facing, and they're trying to foster balance sheet deleveraging in the economy. The ECB is also implementing extraordinary and experimental monetary policies. They are trying to encourage financial stability, lower peripheral borrowing costs with their OMT program, reduce interest rate volatility and therefore the term premium on bonds, just as the Fed is, and to break this systemic contagion between the banking system and the sovereign balance sheet. They're trying to support economic growth. They're trying to offset fiscal headwinds. They're trying to build a bridge until policymakers in Europe can implement structural reforms to address the economic inequalities among the countries in the Eurozone and to address the imperfections in the structure of the EMU. And the BOJ's experimental monetary policies, which are just underway, is to break the structural deflationary forces in the Japanese economy and to spur growth through consumption and exports. But importantly, they need policymaker support through massive fiscal spending and structural economic reforms to succeed at their task. The central bank will not be able to accomplish these objectives by themselves. Here we show global growth. The world is in blue. Importantly, the advanced economies is in green, and the dotted lines show expected growth going forward. Quite low, and certainly lower than what they were prior to the crisis, whether you're looking at the advanced economies or the emerging economies. Well, the U.S. growth is on a new normal growth path, as we term it, where growth will be slow for many years in the 3 to 4% range. Here we show the MOVE index, which is an indication of interest rate volatility in the United States. That has come down quite dramatically, so the Fed has been successful in tempering interest rate volatility. That's helped or allowed the housing market to recover. It's allowed risk assets to rise, and it's allowed corporates' balance sheets to become, turn into some of the best, in their best shape that we've seen in a very long time. But corporations, as we know, are still sitting on huge amounts of cash. They are not using that to reinvest in their businesses or capital expenditures. We're starting to see that cash being used with a pickup in M&A activity and greater dividend distributions. Well, the biggest structural problem in the United States economy is the unemployment rate. And the unemployment rate is not only high, but people have been unemployed for unusually long periods of time, which has a real impact on, ultimately, the productivity of the U.S. economy. Importantly also is the unemployment rate among young workers, those that are entering the workforce, who need to develop their skills to become productive members of the labor force, is at 23%. There are other structural problems in the United States that the monetary policy does not have, or the central bank does not have the ability to address. So the Fed has a very blunt tool to address the unemployment structural problem. But we also have a decline in the educational system in the United States, a decline in the infrastructure in the United States, and a decline in immigration in the United States. None of those structural problems can be addressed by the Fed's monetary policies. Europe will be in a recession this year. However, the difference in growth this year will be quite dramatic, with the core Germany growing at 0 to perhaps slightly positive, and the peripherals growing at extremely negative rates. In the Eurozone, unemployment rate is high, but as with the GDP growth, very uneven, with unemployment in the core relatively low, and in Germany very low, and in the peripherals extremely high. And if you look within the young populations of the peripheral, worryingly high. Well, the OMT program has reversed capital flight, and here we show the percent of private capital flows as a percent of GDP in Italy and Spain. The OMT program clearly had a massive effect on the borrowing costs of these countries, but it brought back in capital into their economies, foreign capital into their economies, and it also stopped the outflow of bank deposits, which in Europe and any country, a bank run can have a self-fulfilling effect on creating a sovereign crisis. Well, the Fed has pushed investors out the risk spectrum. Here we show the spread of various sectors of the U.S. corporate index or market. The Fed has been able to bring corporate bond yields from 600 basis points over treasuries down to an average of about 140 basis points over treasuries. We believe that the Fed's program, quantitative easing programs, excessively low monetary policy rates, has been about an 8 to 10% subsidy to financial asset prices. Well, yields in sectors and markets have fallen across the world. Some sectors are rich, some are fair, but very few are cheap. If you look at the 10-year Treasury, while the Fed, we think, has added about an 8 to 10% impetus to financial market returns, we think that they've lowered the 10-year yield, U.S. Treasury 10-year yield, by roughly 50 to 75 basis points by buying 80% of all new issuance that's coming out, and also promising to keep monetary policy accommodative for an extremely long period of time. Well, the BRICS are also on a tempered recovery, but as you see, their growth rates are lower than what they've experienced historically. So historical growth rates at somewhere around, in real terms, somewhere around 4 to 5%, are now somewhere in the 3 to 4% range. But the central bankers have distorted the financial markets, which is really impacting investors and savers. The money market fund and the short-term markets are broken, given very low short-term interest rates. $1 trillion money market industry in the United States is shrinking. They can't deliver a positive return to their investors. Those institutions that have long-term liabilities are seeing their liabilities rise with low interest rates, but they're unable to find assets in the market to match the rising costs of their liabilities. Banks' net interest margins are falling as they are also not able to find adequately yielding securities to give them an adequate spread over the deposit rates they're paying. In a world where massive amounts of wealth was destroyed in 2008, it's very difficult for people to safely rebuild their savings with such low interest rates. And historical asset correlations and volatilities have changed due to manipulated risk-free rates and the policymakers not only refereeing the financial markets, but also participating in the financial markets. Price discovery has become very difficult for investors, and liquidity in some markets have become problematic. And this all leads to difficulties in asset allocation because the rules that people practiced in asset allocation don't hold anymore. As I've noted, the Fed is reflating risk assets. But as we see, looking at the S&P 500, the policies are having diminishing effects. And so between each of these yellow bars is a different quantitative easing program. So quantitative easing 1 was in 2010, quantitative easing 2 was in 2011, and so forth. You're seeing a diminishing effect as the Fed keeps trying to generate wealth accumulation and wealth growth through pumping up risk asset prices. Here we show in yellow the debt to GDP for the United States government, and in blue the interest payments per GDP. Low policy rates are allowing the government to continue to run large fiscal balances because they can borrow so cheaply. And there's been debates between Republican congressmen and Ben Bernanke that perhaps the central bank is trying to help out the government. Here we show the yields and the spreads over bunds for peripheral countries in Europe. The OMT program brought Spanish and Italian 10-year yields down from 7% to 5%. Greece yields have fallen from 14%. Here we show, again, the bars are different Fed quantitative easing programs. Yellow is the S&P 500, blue is the 10-year Treasury. The Fed has put a wedge between risk and risk-free assets. Traditionally, if the S&P went up, bond prices fell, and vice versa. That's no longer the case. They both go up together, and they both go down together. Another distortion is shown here. The green line is Citibank's economic surprise index. It's an indicator of whether economic data that comes out is higher or lower than what the market expected. And if you look prior to November of 2011, there was a very tight correlation. If the surprise index surprised on the upside, equities rose, bonds fell. If it surprised on the downside, vice versa. Now, it doesn't matter. I talked about the difficulties of institutions with long-term liabilities finding adequate securities. Here we're showing the percent of pension funds and their funding ratios, and you've seen that's fallen dramatically from a very positive rate in 2000. I'm showing here the correlation of EM equities, commodities, REITs, and high yield to global equities. The correlations are all moving very close to 1, if not rising materially from what we had back in 1999 to 2007. And finally, the question that's been talked about, how do these central banks exit from these policies, and importantly, when do they exit from these policies? Well, reflationary policies could end badly in high inflation and high interest rates. That's what we had in the United States in the 1950s and the 1960s. The Fed is trying to engineer a bridge, and they're trying to engineer a bridge that will lead to to take a very levered economy with aging demographics and huge unfunded liabilities to the next productivity boom in the United States. If the Fed can keep interest rates low, if they could keep inflation in check and keep nominal rate of growth growing at 4 to 5% a year for the next 5 to 10 years, understandably that's a big wish list, then the probability of the U.S. economy innovating itself to the next productivity shift is high, and this handoff could run smoothly. but that's a big if. Thank you very much.